Welcome back to Smart Stock Sam, the channel where we cut through the noise and get straight to what actually matters for your portfolio. Before we dive in, I need to ask you something. What if I told you that a company just missed its revenue target by over $2 billion, burned through $6.6 billion in cash in a single quarter, has an active Department of Justice investigation hanging over its head, and its stock still exploded nearly 20% overnight? That is not a typo. That is not a glitch in the matrix. That is super microcomputer, ticker SMCI, and today we are cracking open everything you need to know. A massive earnings beat hiding inside a massive revenue miss. $11 billion worth of servers sitting in warehouses waiting for customers to literally turn the lights on. A short squeeze building like a pressure cooker. And a legal storm that could flip this entire story on its head. By the end of this video, you will know exactly what the smart money is watching, what the charts are signaling, and whether this post-earnings surge has genuine legs, or whether it is just a beautifully dressed trap. Hit that like button if you find value here, and let us get into it. To understand why the market responded with such ferocity, we have to talk about the setup going in. The stock had been grinding under enormous pressure, closing at $27.83 just before the report. Sentiment was ugly. Bears were piling in. Short interest was elevated and growing. The whisper on the street was that SMCI was about to confirm every nightmare narrative. Governance failures, losing market share to Dell and HPE, a supply chain that had fallen apart. The expectation was pain. So when the numbers hit the tape, the market did not just rally, it erupted. The stock surged into the $33 range in after-hours trading, a gain of somewhere between 18 and 20% in a single session. But here is what most people got wrong about why. This was not a revenue beat. Revenue missed, and it missed badly. This was a pure relief rally, built entirely on the realization that something far more important had quietly turned a corner underneath all that noise, and that something was profitability. When you combine a surprise profitability recovery with guidance that basically told Wall Street the demand pipeline is full and only waiting for infrastructure to catch up, you get exactly this kind of violent, disorienting reprice. The $6.6 billion cash drain and the DOJ investigation are still real. They did not disappear. But the market decided, at least for one session, that they were already priced in. Now let us get into the actual numbers, because this is where the story gets genuinely fascinating. SMCI reported a non-GAAP diluted earnings per share of 84 cents. The street was looking for 62 to 63 cents. That is not a modest beat. That is a complete demolition of consensus. It tells you that in spite of all the chaos surrounding this company, in spite of the regulatory headaches and the delayed filings and the auditor drama, management found a way to squeeze dramatically more profit out of every server they shipped. On the revenue side, total sales came in at $10.24 billion against an expectation of $12.33 billion. That $2 billion gap is real, and I am not going to wave it away. But context matters enormously here. $10.24 billion still represents 121.7% growth year over year. They are essentially doubling the size of their business on an annual basis, and that is in what the bears are calling a bad quarter. The metric that arguably mattered most to the bulls, adjusted gross margin, expanded to 10.1% from a genuinely alarming 6.4% just one quarter prior. That is a nearly 4-point swing in a single reporting period. And in the server business, that kind of move is seismic. So how exactly does a company expand gross margins by nearly 4 full percentage points in one quarter while simultaneously burning billions in operating cash and missing its own revenue targets? That is the question that separates investors who actually understand this business from those who are just reacting to headlines. The margin expansion was not accidental, and it was not cosmetic. It was the result of 3 very deliberate operational decisions. First, management made a conscious shift toward a higher margin product and customer mix. Rather than chasing every volume deal available, they leaned into their premium AI solutions. Deep rack liquid cooling systems, dense GPU cluster configurations, and full-stack architecture builds that commands meaningfully higher pricing than standard rack hardware. Second, they benefited from a reduction in tariff-related costs that had been quietly compressing margins in prior periods. And third, and this is the one that most analysts underweighted, they dramatically cut their expedite fees. In the early chaos of the AI build-out boom, SMCI was literally paying emergency premiums to move components faster through a strained global supply chain just to keep up with order flow. That supply chain has now matured enough that those emergency surcharges are fading. Each of these three forces reinforced the others, and together they produced a margin profile the market had not seen from SMCI in several quarters. Here is the question every investor needs a direct answer to. If AI demand is truly this ferocious, if every major hyperscaler and enterprise IT department on the planet is in an arms race for GPU-accelerated compute, then why on earth did SMCI miss its revenue number by $2 billion? The answer from management is consistent and specific. This miss is not about lost demand. It is not about losing contracts to competitors. It is a physical world infrastructure problem happening on the customer side. The servers are built, they are manufactured, tested, and sitting in warehouses ready to be deployed. The bottleneck exists inside the customer's own data centers: inadequate power feeds, cooling systems that are not yet online, and networking infrastructure that has not been commissioned. The customers have the purchase orders in place, but they do not yet have the physical capacity to accept delivery and spin these systems up. That makes this revenue deferred, pushed into the fourth quarter and into fiscal 2027, not lost to a competitor. That is a fundamentally different story, and it is the difference between a temporary operational delay and a structural demand problem. The working capital stress that comes with $11.1 billion in finished inventory sitting on the balance sheet is very real, and it creates genuine short-term liquidity pressure. But if the delivery timeline holds, that inventory converts to revenue on a schedule management believes they can control, which is exactly why the forward guidance landed with such force. For the fourth fiscal quarter, management is projecting revenue between $11 billion and $12.5 billion, comfortably above Wall Street's prior estimate of $11.07 billion. On the earnings side, they guided to 65 cents to 79 cents per share, well above the 55 to 57 cent analyst consensus. For the full fiscal year, they trimmed the lower bound of their revenue range slightly to produce a target of $38.9 billion to $40.4 billion. The bears will point to that trim as a crack. The bulls will correctly note that trimming the floor while raising the ceiling on a per-quarter basis is not a warning. It is a recalibration toward a more defensible and realistic set of numbers that the company actually intends to deliver. The message embedded in all of this guidance is unambiguous. AI demand is structural, the pipeline is full, and the only question is timing. Beyond the near-term numbers, SMCI is attempting something far more strategically significant than just selling more servers at better margins. They are trying to fundamentally redefine what category of company they occupy. The old identity, high-volume, relatively commoditized server hardware manufacturer, is a business that is inherently cyclical, permanently under pricing pressure, and always at risk of being squeezed by larger players with deeper supply chain relationships. The new identity, which management calls Data Center Building Block Solutions, is an entirely different value proposition. The vision is to own the complete integrated architecture layer of the modern AI data center, not just the compute hardware, but the thermal management systems, the power distribution architecture, the software orchestration layer, and the full-stack deployment ecosystem that enterprise customers increasingly want to buy as a turnkey package, rather than assemble from multiple vendors. Management has stated explicitly that they expect this integrated segment to contribute more than 25% of total company profit in the coming years. If they execute on that transition, the margin story we saw this quarter is not a one-time event. It is the beginning of a structurally higher baseline. But execution from here needs to be virtually flawless, and flawless execution is not exactly what SMCI has been known for recently. That credibility gap is precisely why Wall Street's reaction has been cautious despite the strong print. Institutional investors still control 84.06% of the float, and there has been some meaningful recent accumulation from names like Danske Bank and STR's Ohio, which signals that the smart money has not abandoned the name entirely. But look at what the major analyst desks did immediately after the report. JP Morgan revised their price target down to $28. Mizuho moved to $25. Bank of America went all the way to $24. The analyst consensus sits at a lukewarm hold with a composite score of 3.38, and the average price target lands somewhere in the $32 to $35 range. What that tells you is that Wall Street believes the growth narrative but does not yet trust the execution environment, and the baggage driving that distrust is not trivial. There is an active Department of Justice investigation into potential China export control violations involving former company personnel, the same investigation that originally triggered a 33% collapse in the stock price. SMCI says it is cooperating fully, but trust fractured by a federal investigation takes significant time to rebuild. Layered on top of that, there are serious governance concerns stemming from the Auditor departure in 2024 and formally acknowledged weaknesses in internal financial controls. There is active class action litigation with a critical lead plaintiff deadline arriving in late May. And there are unconfirmed but persistently circulating rumors about a lost partnership potentially worth $1.4 billion. Could every single one of these legal and reputational threats somehow resolve cleanly, simultaneously, without inflicting any lasting damage on the business or the stock? Is it even remotely plausible? The probability is not zero, but it would be one of the more remarkable corporate rehabilitation stories in recent memory. From a technical standpoint, the chart is starting to reflect a more constructive picture. Before earnings, the stock had already reclaimed its 20-day and 50-day moving averages, a quiet but meaningful signal that accumulation was quietly underway. The post-earnings surge to approximately $33 is the real inflection. The Relative Strength Index sits at 53.31, which is essentially neutral territory. That means there is significant runway remaining before the stock enters technically overbought conditions. The MACD has crossed into a buy signal. The major ceiling sitting overhead is the 200-day moving average at $37.64, still roughly 24% above current prices and almost certain to act as fierce resistance on any push higher. And layered on top of the technical setup is the short squeeze potential, which adds a genuinely explosive dimension. Short interest stands at 16.79% of the float with nearly 4 days to cover. The options market had only priced in a 13.54% move into earnings. The stock delivered 18%. Bears who were positioned for a muted reaction or an outright breakdown are now trapped above their entry. Every dollar of sustained buying pressure from here mechanically forces those short sellers to cover, which generates additional buying pressure on top of buying pressure. Your key pivot level is between $31.70 and $31.74. Hold that on any pullback, and the first resistance target is $34, then the 200-day at $37.64, and a full squeeze scenario opens the door toward $40, where heavy call interest and analyst price targets cluster. On the downside, $30 is your first psychological floor, and $28 is the absolute must-hold level. The options chain has massive put interest anchoring that number as the definitive line in the sand. Before I wrap up, I have to share important disclaimer with you like always. Nothing you have heard in this video is financial advice. Everything here is purely educational and for informational purposes. Always consult a qualified financial professional before making investment decisions and never risk capital you cannot afford to lose. So the final verdict on SMCI, a tactical breakout carrying heavy structural baggage. For the short-term trader, the technical setup is genuinely attractive right here. Hold 3170 and the squeeze toward $40 is a real and well-supported probability. For the long-term investor, three things must go right at the same time. The 11.1 billion in inventory converts to cash through clean deliveries in the next 2 quarters. The DOJ investigation reaches a resolution without existential consequences, and the delayed Form 10Q gets filed without new revelations that reignite governance fears. All three go right, and the long-term bull case is extraordinarily compelling. Even one goes wrong, and this narrative cracks fast. High stakes, high upside, high risk. That is SMCI right now. Now I want to hear from you. Here is the question I am thinking about this week. Do you believe SMCI converts that 11.1 billion in deferred inventory into clean cash flow before the end of this fiscal year? Or do the data center delays run long enough to turn a timing problem into a balance sheet crisis? Drop your answer in the comments. I read every single one. If this breakdown added value, smash that like button and subscribe so you never miss a breakdown like this one. And if you want to go the extra mile in supporting Smart Stock Sam, send a super thanks through YouTube's support feature. Everyone goes directly back into the research. Stay sharp, keep those stops tight, and I will see you in the next one.